Okay, so in this video we're going to look at how to find the value of a stock with no expected growth in the dividend. So let's take a look at our problem. So here's our problem. What is the expected current price of a stock which paid a dividend of $6 per share yesterday if no growth is expected for the dividend in the future and if the rate of return required by shareholders is 12%? Well, let's start off by looking at our constant growth formula, which is the expected value of the stock today should be equal to D1, which is the dividend a year from now, over KS, which is the required rate of return, minus G, where G is the growth rate. And if you've been watching the other videos, you will know that D1 is equal to D0 times 1 plus the rate of growth. So let's go ahead and substitute. So we'll have D0 times 1 plus the rate of growth in the numerator. And then I have KS minus G in the denominator. Now, you might be looking at this and thinking, but wait a minute, we have a stock that has no expected growth, so why are we using a constant growth formula? Well, as it turns out, the constant growth formula actually works with no growth because no growth is a constant rate of growth of 0. So if I go ahead and plug in a growth rate of 0 for my formula, I get D0 in the numerator because I would have 1 plus 0, which is 1, and 1 times D0 is D0. And then I have KS minus 0, which is just going to be KS in the denominator. And if we have no growth in the dividend, then every dividend is the same as every other dividend. So really, I don't even need this subscript here for the dividend because they're all the same. So that would mean that if I have a stock with no expected growth, all I wind up doing is taking the dividend per year, dividing by the required rate of return. Now, if you pause to look at that for a moment, and you consider what that actually means, we have the same amount every single period, every year, this dividend, and then we have a required rate of return. So same amount every period per year forever divided by a rate of return. And somewhere in the back of your mind you should be thinking that looks an awful lot like the present value of a perpetuity, which is found by taking the payment divided by the interest rate. And if you are thinking that, you're right. That's exactly what we're doing because we have the same amount every single year for forever, so we have a perpetuity, and just we're calling the payment a dividend now, and instead of calling it an interest rate, we're calling it a required rate of return, but we're still doing the same fundamental thing. So to actually solve the problem then, we just need the dividend and the required rate of return. Well, it is specified the dividend is $6 per share, and then the rate of return required by shareholders is 12%. So all we need to do is take $6 divided by the decimal version of 12%, which is 0.12, to find our expected price today. And I recommend that you pause the video to try that and see what you get. Okay, so if you paused the video and tried that, what you should have gotten was $50. So that would indicate that we would expect that this particular stock would have an expected price of $50 per share today. And that is how you find the present value of a share of stock with a constant dividend per year and no expected growth with a particular required rate of return. I recommend that you try a few other examples and see how you do with those.